Welcome to the Research Desk.
Let's get right to it.
Today's mission is a critical analysis of a strategic brief that, frankly, demands your immediate attention. We're breaking down Damodaran's valuation levers. Physics trumps probabilities.
And we're not dealing in casual speculation today.
No, absolutely not. This is the Research Desk's briefing on today's source material, and it is designed specifically for you, the principal decision maker.
Because you're navigating a market environment right now where the traditional frameworks are, well, they're fundamentally breaking down.
They're shattering. The central tension we need to unpack here is the massive collision between probabilistic optionality,
Which is what your spreadsheets say should happen.
exactly, versus physical and geopolitical constraints, which is what reality will actually permit.
It is much worse than just a market transition. It's a full-speed collision.
Right.
Traditional discounted cash flow models, the absolute bedrock of institutional finance, are currently providing a false sense of quantifiable certainty. And we are in a decidedly non-linear market.
If you're basing your capital allocation purely on mathematical elegance right now, you are flying blind.
Completely blind. Extreme upside and downside risks are no longer governed by the probability matrices of the last decade. They are governed by what the brief calls kinetic reality.
Kinetic reality.
Yes, we are talking about physical grid constraints, sovereign national interests, and irrational market narratives.
A spreadsheet simply cannot model the physical electrical grid that powers artificial intelligence.
No.
Nor can it model the sovereign military power that protects the supply chain or the psychological narrative that sustains its valuation.
So if the physical reality is hitting a wall, you have to ask why investors are still modeling infinite growth.
It comes down to a misplaced faith in baseline diagnostic tools.
Mm-hmm.
People are treating their WACC, the weighted average cost of capital,
By their DCF, the discounted cash flow models.
like crystal balls. These are indispensable financial anchors, yes, but they are failing entirely to navigate the current geopolitical and technological scales.
You have to understand that your financial models are currently overlooking three distinct realities that define this era.
Let's lay those three realities out clearly because they are the foundation of this entire shift.
First, you have the binary cliff.
Right.
Financial models treat geopolitical risk as a static, maybe 2% line item penalty that you just neatly factor into your margins.
Which is a fiction.
Total fiction. Geopolitical risk structurally alters future cash flows as a binary event. It either happens or it doesn't. If it does, the model doesn't just adjust.
It shatters.
Exactly. Second is the physical ceiling. Financial models falsely assume infinite compute availability. The math basically assumes that if there is consumer demand, the physical supply will just magically appear to meet it.
And the third.
The third is the narrative premium. We are seeing profound psychological biases distort the baseline valuations of hypergrowth giants like NVIDIA, Meta, and Tesla.
The story is overriding the fundamental physics of the businesses.
Precisely.
Which brings us to Aswath Damodaran's classic valuation levers. For decades, these have been the gold standard for valuing a company.
Revenue growth, operating margins, capital efficiency, and discount rates.
They provide financial discipline. But what this briefing argues is that in a hypergrowth environment, they are necessary, but completely insufficient.
Insufficient because the basic geometry of the market has changed. Linear sales projections utterly fail to capture power law scaling.
And let's look at operating margins, because this is where the illusion is arguably the strongest.
Right now, incredibly high operating margins in the semiconductor space are often just a reflection of temporary geopolitical chokeholds.
They do not reflect sustainable operational efficiency.
No. If you have a functional monopoly because of export controls, your margins look brilliant. But that is a political artifact. It's not a permanent business fundamental.
Furthermore, standard discount rates cannot properly weigh non-ergodic risks.
Let's translate that for a second. Financial models are great at predicting average outcomes over a long timeline, but they completely fail at non-ergodic risks.
In plain English, if a risk takes you to zero, you don't get to play the game again.
Exactly. You cannot average out a fatal blow to your supply chain. You cannot discount a terminal zero.
And that brings us to how sovereign volatility operates in this environment.
Right.
It acts like the curvature of space-time.
It fundamentally warps the market mechanics around it.
Now, to be entirely objective and impartial here, we are looking strictly at the geopolitical realities outlined in the text. We aren't taking political sides.
We are just reporting the risks. The Taiwan Strait and the potential of a TSMC blockade represent massive non-ergodic fat tail risks.
A traditional DCF model simply cannot digest the erasure of the world's primary advanced semiconductor foundry.
The brief uses a fantastic historical analogy here: digital self.
Right, when you see foundational hardware companies pulling in gross margins exceeding 75%, you are looking at digital salt.
It's a perfect framing. Centuries ago, if you controlled the regional salt trade, you had a geographic monopoly. You could charge whatever you wanted because the constraint was physical location.
Today, foundational hardware margins are the byproduct of a temporary geopolitical monopoly.
It is incredibly lucrative, but it is deeply fragile. The brief refers to this control as the mandate of heaven.
If international trade routes close, or if the political winds shift and export controls tighten abruptly, those operating margin levers break instantly.
The math doesn't degrade by 3% a quarter. It snaps to zero overnight.
And even if the geopolitics holds steady, the physical world is throwing up a brick wall. Digital scaling is hitting hard physical infrastructure ceilings.
We aren't just talking about writing better code. We are talking about atoms.
The brief outlines deeply physical constraints regarding HBM high bandwidth memory and CoWoS chip-on-wafer-on-substrate advanced packaging.
These represent a rigid, hard ceiling on compute expansion. You simply cannot code your way out of a silicon packaging bottleneck.
And the constraints get exponentially more severe when you zoom out from the silicon to the actual electrical grid.
The physical numbers here should force a complete recalibration of your timeline. Listen to this. There is currently a 4 to 7 year waiting period for new data center grid connections in major hubs.
4 to 7 years.
That acts as a rigid, unyielding constraint on how fast hyperscalers can actually deploy capital.
You also have to factor in the industrial metallurgy. Critical power components, things like specialized transformers, are facing lead times of over 120 months.
That is more than 2 years just waiting for the cooling systems required to generate the AI revenues your spreadsheet says you will have next quarter.
This creates what the briefing brilliantly terms the Antikythera risk.
For those who don't know, the Antikythera mechanism was this ancient Greek analog computer. It was incredibly advanced for its time.
But it was an anomaly because the surrounding metallurgy and industrial base of the era couldn't actually support or scale it.
Right, and the parallel to today's AI is chilling. AI models face a complete value collapse if the surrounding industrial metallurgy and power grids are not valued as primary constraints.
The neural network architecture is brilliant, but without the physical copper, the transformers, and the raw electricity.
Its terminal value is zero. You are valuing a software revolution, but you are bottlenecked by a 1950s era electrical grid.
So, given these massive physical and geopolitical constraints, how do we justify the current market premiums?
Here is where the concept of the network state of AI dominance comes into play. We have to look at these giants not just as companies, but as infrastructural ecosystems.
Let's explicitly frame NVIDIA's 262% year-over-year revenue growth. You should not view that as just hardware sales.
Absolutely not. That revenue functions as a tax on the entire AI ecosystem.
An ecosystem monopoly.
CUDA, their computing platform, is not just software. It is a proprietary language that currently dominates mere hardware dialects.
If you want to speak AI, if you want to participate in the future of compute, you pay the NVIDIA tax. Full stop.
We also see this network state dynamic with Meta. Their pivot to extreme capital discipline, combined with their AI-driven advertising relevance, structurally enhances a competitive moat that smaller players simply cannot cross.
But the most crucial highlight from this section, the thing that really shifts the paradigm, is the concept of sovereign AI clouds.
Hyperscalers are currently executing $35 to $40 billion in annual capital expenditures. But this isn't just corporate IT spending anymore.
No, it has become an issue of national security.
Governments globally are realizing they need sovereign compute capacity. They cannot rely on foreign infrastructure for their foundational AI models.
This is creating non-cyclical, politically mandated demand floors. Nations are stockpiling compute the way they stockpile strategic petroleum reserves or fighter jets.
Current hyperscaler valuations reflect a mispriced call option on this exact infrastructure dominance. It perfectly mirrors the 100x returns of those who correctly modeled Amazon AWS back in 2003.
When the market thought it was just a bookstore buying too many servers. But, and this is a massive but, the danger lies in assuming this scaling is infinite. Quantifiable certainty is currently masking a massive narrative fallacy.
Markets are constructing these unquestionable narratives that the growth will never hit a wall.
That the power will always be there, that the margins will stay at 75% forever.
History has a very loud warning for this exact scenario. We must draw a direct, unignorable line to the Cisco 2000 bubble precedent.
Investors today are suffering from severe historical amnesia and anchoring bias.
Back in the year 2000, Cisco traded at 100x multiples because they were the undisputed king of building out the internet backbone.
The narrative was identical. Everyone needs routers, so Cisco will grow forever.
But once the physical build-out peaked, once the plumbing was actually installed, those multiples dropped 80%. The technology succeeded, the internet changed the world, but the scarcity premium vanished.
The astounding current metrics in the AI space are heavily distorted by that same kind of scarcity premium. You have to prepare for mean reversion.
The physical grid constraints and the geopolitical bottlenecks will inevitably force a reversion to the mean. True equilibrium margins will compress violently once this current capital expenditure cycle peaks.
When the supply of compute finally catches up with the localized demand.
Which brings us directly to the myth of capital efficiency. We treat internal capital efficiency like it is the ultimate shield against market downturns.
But the brief argues that right now, capital efficiency is acting as a modern Sisyphus myth. You are pushing a boulder up a hill, optimizing every penny, while ignoring the macro forces that can crush you.
Let's use Tesla as the primary case study here.
Tesla is famous for its intense internal capital discipline and manufacturing innovation. Yet we've seen their operating margin compress from 17.2% in the first quarter of 2022 down to roughly 7.6% in 2024.
And this margin compression highlights what the brief calls Tesla's O-ring theory risk.
Think back to the Challenger space shuttle disaster. You had a massively complex, deeply integrated physical system, millions of parts working perfectly.
But a single failure, a frozen O-ring, destroyed the entire project.
In complex manufacturing and energy systems, it is a non-linear failure.
One supply chain bottleneck, one battery mineral shortage, reduces the terminal value of the output to absolute zero for that quarter.
Furthermore, we must contrast internal capital efficiency with state-directed capitalism. Remaining entirely impartial and looking strictly at the data, we observe that your internal corporate efficiency is often completely overridden by what the brief calls geopolitical alpha.
This is a vital concept. Take a competitor like BYD. They leveraged $3.7 billion in direct state subsidies.
This proves a harsh reality for the traditional financial modeler. You can have the most elegant, ruthlessly efficient internal operations in the world and still be completely outmaneuvered by a competitor wielding state-backed geopolitical leverage.
Geopolitical alpha trumps your internal spreadsheet efficiency every time.
This proves that the probabilistic margin of safety you have relied on your entire career is a ghost map. It is showing you roads that don't exist anymore.
The tech risks you are allocating against are non-ergodic. Monte Carlo simulations, ensemble averages, they cannot predict the survival trajectory of an individual company facing a sovereign-level supply chain shock.
It's the turkey analogy.
Exactly. This illustrates the flaw of historical data perfectly. For 1,000 days, the turkey's predictive model says the farmer is its best friend. The farmer feeds it, houses it, protects it.
The statistical data is flawless. Every data point screams security.
But that predictive model guarantees slaughter on the morning of day 1001, Thanksgiving.
A TSMC blockade isn't a 2% margin of error. It's Thanksgiving for the tech supply chain.
Spot on. Look at the 1971 Nixon shock, which decoupled the U.S. dollar from gold. It rendered decades of prior macroeconomic valuation models obsolete in a single afternoon.
A severe escalation in the Taiwan Strait would be an identical, unmodelable shock.
You simply cannot assign a standard deviation to an event that rewrites the basic laws of physics for your entire global supply chain.
So we have to redefine our mental models for nonlinear markets. You need a paradigm upgrade, and the brief outlines two major shifts in how you must think.
First shift. Biology over pure history.
The value of an AI firm will be determined by its adaptation to local constraints like power availability and sovereign regulations, much like a biological organism adapting to a harsh environment.
Second shift. Geopolitics as physics. Geopolitics is no longer an external, abstract risk factor. It is the fundamental macro driver. It is the basic physics of the market.
However, to maintain total analytical rigor, we must also acknowledge the ultimate counter-risk to this entire physical infrastructure thesis.
And that is algorithmic efficiency.
Right. What if the software gets so good it doesn't actually need all this hardware?
Precisely. Breakthroughs in one-bit large language models or true recursive self-improvement could completely dissolve the current hardware bottlenecks we just spent the last 10 minutes discussing.
If AI achieves pure digital decoupling, meaning the software's energy efficiency outpaces the projected compute demand, the massive physical infrastructure thesis collapses.
If you are heavily weighted in industrial infrastructure, copper, and power grids, you must hedge against the possibility that next year's algorithms suddenly require a fraction of the power to achieve the exact same benchmark.
You are a principal decision maker, and you don't just need theory, you need directives.
The brief provides 6 highly actionable portfolio strategies to navigate this. Let's hit these directly.
Step 1, audit the power gap.
You cannot hold an AI position without cross-referencing their projected compute demands against the actual physical grid capacity in their specific operational regions. Look at the local utilities, not just the company's guidance.
Which leads directly to step 2, apply a physical haircut.
If a target region has a projected power deficit exceeding 15% for the 2026 to 2027 window, you need to ruthlessly cut your terminal values for that data center project by 20 to 30%. The electricity simply won't be there to power the projected revenue.
Step 3, execute the shadow infrastructure spread.
Go long on the foundational physical layer power, cooling, transformers. Look at the industrials. And aggressively short the AI wrapper sauce companies that are just building thin applications on top of OpenAI's API without any foundational physical moats.
Step 4, apply a sovereignty premium.
Add 200 to 300 basis points of risk to the weighted average cost of capital for any firm that has greater than 20% of its revenue exposure tied to geopolitically contested regions. You must price in the Thanksgiving risk.
Step 5, monitor the bullwhip.
Track inventory to sales ratios and GPU lead time deltas explicitly. Do not wait for the quarterly earnings call. Track the supply chain physically to front-run the hardware cycle turns. When lead times drop, the scarcity premium is ending.
And finally, step 6, shift to Bayesian valuation.
Stop using static 5-year annual projections. You must reprice your platforms dynamically, constantly updating your prior assumptions based on the release of new open-source LLM benchmarks. The ground truth changes monthly. Your model must do the same.
Mastery in this environment requires integrating the grid, the sovereign, and the narrative.
Financial history guarantees absolutely nothing when you are in the middle of a structural paradigm shift.
True value is no longer just about building a good product. It is about actualizing geopolitical leverage into institutional necessity.
The takeaway is absolute. The only surviving margin of safety belongs to the investor who masters physical throughput, sovereign risk, and narrative life cycles.
No financial model, no matter how mathematically elegant, can substitute for the physical grid that powers artificial intelligence, the sovereign state that protects it, or the narrative that sustains its multiple.
Exactly.
I want to leave you with one final structural revelation to mull over as you recalibrate your allocations this week.
The feedback loop.
Yes. As we look at the blinding speed of these AI ecosystem updates, consider that the very metrics we are using to judge AI performance might be driving the capital that builds the constraints. Your measurement tools are actively shaping the reality they are trying to measure.
The framework is too Newtonian based on action and reaction for a quantum market, where the act of valuation changes the asset's behavior.
Thank you for joining today's strategy session. Apply these frameworks rigorously. This is the Research Desk officially signing off.